Fortune favors the bold, which is why billionaire Eric Sprott and legendary investor Rick Rule are taking advantage of the lowest valuations in the mining sector in over 3 decades by accumulating millions of shares of this tiny new stock led by Keith Neumeyer, a mining entrepreneur who has already built 2 separate billion-dollar companies. This new venture, starting with 18 assets on day 1, including gold, silver, copper, and zinc projects, has already identified 60 additional quality assets in distressed companies that management will work to acquire. To learn more about this incredible opportunity, visit futuremoneytrends.com/fortune.
Hello everyone and welcome into crushthestreet.com. I am Kenneth Amaduri and I'm here with Ronni Stöferle. He's an author, he's a writer, he's been talking about gold and has a very bullish target. He's been doing this since 2006. He's an Austrian economist, and I'm really excited to talk to him today and kind of get his thoughts, because as we have seen, gold has been smashed, and we're at 2010 lows right now. Yesterday it hit 1,086, and I'm really excited to kind of just get his thoughts on this. First of all, Ronni, thanks for coming on the show with me today.
Hi, Kenneth. Thanks for inviting me.
Well, let's get off with your opinion and just kind of what's going on. Give us a little assessment of what's going on in the precious metals market as of now.
We could talk about that for hours probably. I think that what's going on at the moment is, first of all, a very successful trader once told me, the market is a maximizer of pain. I think there were quite a lot of people that held on to their gold even though they were down significantly. But this move might be like the final thing that really leads to complete capitulation in gold, but especially in the mining equities. Now, what are the reasons for that? I think that what we saw on Monday, this huge sell order, I think with a notional amount of 2.5 billion US dollars that were dumped on the market. You know, there are lots of stories and conspiracy things about it, but it's kind of a strange price behavior, I would say. But in general, I would say that there is definitely quite a number of reasons why gold is acting so weak. The main reason is that we're in a disinflationary environment again, meaning that Greece, but also the whole agreement between the US and Iran, and especially China, are acting quite deflationary on the money supply, on the sentiment of investors, and we can gauge that especially from commodities. Have a look at energy prices, have a look at industrial metals, soft commodities. They're all acting extremely weak. And compared to them, and this is from that we can see that this move is pretty much deflationary. And compared to them, gold is actually holding up quite okay, I would say. Now, we should not forget that this is also a consequence of a very strong dollar. Having a look at the gold price in different currencies, we can see that it's still up since the beginning of the year in euro terms, for example, but also in many other currencies. So this dollar rally that we're experiencing at the moment definitely has effects on dollar prices. However, over here in Europe, for example, gold was a pretty good investment since the beginning of the year, but also in 2014 when gold was up 12%. So I think it's kind of a mixed picture. The overall trend is definitely down. We won't argue about that. I think from a contrarian perspective, it's highly interesting, but perhaps it's a bit early to start catching the falling knife.
Yeah, no, absolutely. Ronni, you've written some reports on gold, and I know that's not necessarily like an exact reflection on like the news that just happened regarding like this big sell-off or anything like that. But what are some of the key points in your reports and the things that you're educating your audience about when it comes to gold?
Yeah, in fact, I just released the 9th annual In Gold We Trust report. I started publishing them when I was still working at the bank. Now for 3 years, I'm running my own company together with some partners, Incrementum in Liechtenstein, and we're still publishing the report. It was 140 pages, so it's we try to deliver what we call the holistic view. Meaning we try to understand and to analyze many different aspects. The debt situation in industrialized nations, but also in emerging markets, inflation versus deflation. We're writing about opportunity costs, especially stocks, but also real interest rates. We're writing about big geopolitical things like China and Russia having a number of very important agreements and new institutions. We're writing about mining stocks and we're writing about technical analysis. So all in all, it's a very detailed analysis of the gold market. And I think what really differentiates our report from the rest is that we always regarded gold as money and not as a commodity. And therefore, I think it's crucial for every investor nowadays to really understand the root cause for our problems that we're having at the moment. And this problem started in August 1971 when Nixon closed the gold window.
You know, you mentioned Russia and China, and it reminded me of China releasing their gold reserves. And how much do you think they disappointed the gold markets when they came out with their figures that were much lower than even the conventional news media was even expecting? Even Bloomberg and some of these other websites were surprised that China was coming out with such a low gold number. And it's really interesting to kind of dive into what's going on behind the scenes. Are they just not trying to spook the markets? Are they just, trying to hold their cards tightly and, try to get in there and not shock everything? But I don't know, how much do you think they affected the markets with their announcement of their reserves of gold?
I think it was mostly for the sentiment in the gold market. For real supply demand, it doesn't have any effect, because if they would have said that they now own 10,000 tons of gold or whatever, meant okay, then this is probably a pretty bearish sign, that because they bought a few thousand tons in the last few years and gold still didn't rise since 2011. So, and it also means that if they not continue to buy that much gold every year, who else is going to buy? So I think this whole discussion was, I couldn't really understand it, because there's effectively no impact on the price of gold from my point of view. However, do I trust the Chinese numbers? Not really, because as we're seeing with the GDP numbers, for example, if the Communist Party says we want 7% GDP growth, they will deliver 7% GDP growth. So we can argue probably about the quality of those numbers. And the same is, I think the Chinese are playing it very well. They want to become member of the special drawing rights. I think they've got very good chances. I think that China desperately wants and needs a lower currency, a lower renminbi nowadays. And if they would have announced that they own, I don't know, 3,000 or 5,000 tons of gold, there would have been upwards pressure on the renminbi, of course. And what I could imagine is that they might devalue the renminbi perhaps next year or a bit later. So I think all in all, we have to say the Chinese definitely own much more gold than they have officially announced. There are 4 official institutions that are allowed to hold gold, and the People's Bank of China is only one of them. And I think that the crash in Chinese equity markets that we're seeing right now will be beneficial for gold, because retail investors were pushed into and now I think they might go back to the real safe haven.
Yeah, no, I totally agree with you, and I think it's really interesting what's going on over there in China and their strategy, and I'll be curious to see how it all plays out over the years. Of course, only time will tell. Now, you've been in the finance world for a number of years. You were a money manager, and we now are in unprecedented times. So I'm curious, how has your financial strategy evolved over the years, or has it evolved much? Have you been kind of sticking with whatever it is that you've done for the years, or has it changed significantly as the times have changed?
It has changed a bit. I think my view has broadened, and an equity investor. I never heard about the Austrian School of Economics before, although I am from Austria and I studied in Vienna. Unfortunately, it's not taught in Austria anymore. So that's why we're trying to develop what we call Austrian investing. So combining the insights of the Austrian School of Economics with investments. And the reason for that is that only the Austrian School of Economics really talks about the effects of inflation. The Austrian School of Economics talks about our monetary system and the consequences of our monetary system. And from my point of view, as I've said at the beginning, we're not in a cyclical crisis. We're in a systemic crisis. We're in a crisis of our monetary system. And therefore, most of the charts in my report, they always start in August 1971, because at that point in time, there started a completely new monetary era. And I think we had, as it was called, the Great Moderation in the 80s and 90s. And then 2000, it already flipped. And 2008 really saw big cracks in the system. So therefore, I think if you really want to be a successful investor, you should not do the same like you've done the last 15 or 20 years. You should change your views, and you should definitely think about our monetary system and those systemic things, because I think this is the most important thing right now. As we're seeing, last year the big discussion was only about tapering and the end of QE3. This year, everybody is talking about minor rate hikes. If it's going to happen in September or in December, perhaps, or even in 2016, but shows how addicted our society and our system is to cheap money, cheap liquidity, and I think that we simply cannot afford really higher interest rates, but perhaps the Fed will just hike 25 basis points to sort of make a gesture, but this will probably be it. But that's the clear message. Read about the Austrian School of Economics. It's got great insights for investors. We also wrote a book about Austrian investing. It's called Austrian Investing Between Inflation and Deflation. It's only available in German at the moment, but we will publish it in English by the beginning of September.
Yeah, it's really interesting. What I heard in kind of the way it came off to me, it was like you're talking about investing in a Keynesian world. understanding the way the economy works, but then putting your money to work inevitably the way the Keynesian policies are going to direct everything. And of course, that's the inflationary policies, the debt problems, and the QE and all those things that you're talking about. But what you're talking about is really just having a true understanding of the inevitability of what these policies ultimately lead to, and then setting yourself accordingly. Did I hear that correctly?
Yeah, I mean, there are different approaches to Austrian investing. So I would say there are many different ways how to play it. For example, Mike Spitznagel, who also wrote a book about Austrian investing. He's a very successful hedge fund manager, and he plays it by a long portfolio with having a massive sample. What we are doing, for example, in our fund is we're having our own inflation signal. So we don't care about government statistics. We try to gauge what the market is telling us about inflation. And then we are investing accordingly, long, short, especially in inflation-sensitive assets like miners, gold and silver miners, commodities in general, energy equities, and so on. There's also the approach, for example, by Harry Brown. He was a very famous gold bug in the 70s. He created the so-called permanent portfolio, which is 25% gold, 25% cash. That was a time when cash really yielded 6-7%, of course, 25% equities, 25% bonds, and the portfolio is rebalanced once a year. So I think there are plenty of different ways how to play Austrian investing, and of course there's no 100% right way how to play it. But I think what is really crucial is, as I've said before, to understand our monetary system, to anticipate what Keynesian and monetarist central bankers and politicians will do next. And be prepared for something like 2008 or probably worse.
Yeah, no, I totally agree with you. And when it comes to the miners, I know that's a big topic nowadays, especially with what's going on in the precious metals market. The miners seem to be taking it even worse. But the good news is that a lot of the companies that shouldn't even be around are closing their doors. They're not around. They're not being able to raise the money, and the money is getting directed to the best companies. And that's one of the good things about the bear markets. And I think, and I gotta think, with how bad this bear market has been, the bull market is going to be just as or even more spectacular. And people do have an opportunity now to get in at close to the bottom. I know, if you listen to a lot of interviews over the last couple of years, it probably sounds the same. Everyone's been saying we're at the bottom, we're at the bottom, we're at the bottom. But of course, the lower we go, the closer we are to the bottom. Logically, So, but the reality is eventually this is a cyclical cycle, and it will turn around. And how do you see the forward, looking forward and anticipating what's going to happen in the mining sector?
Well, in general, just to give you a number, the total market cap of the HUY index, the gold bucks index, that has got the 16 largest gold and silver miners, and is representative for, I would say, like 70 to 80% of total gold and silver production worldwide. It's got a combined market capitalization of $55 billion at the moment. The cash hoard of Apple is $200 billion. So they could buy the 16 largest gold and silver mining companies 4 times. So that necessarily doesn't mean that it can't go lower, but it already shows that there's This sector is definitely undervalued at the moment, and probably it's the most hated and most contrarian sector that you can invest in at the moment. I think what miners will, of course, need is a rising gold price. If gold continues to fall or go sideways, I don't expect too much from the miners. However, I think that the leverage of the miners is much bigger than in the years before, because the good ones strengthened their balance sheets. They wrote off risky projects. They raised capital. They are concentrating on shareholder value again, and not on only maximizing production. They're becoming much more conservative again, and they really got their costs under control. So once gold starts rising, I think the leverage that miners have, which is already large, is probably bigger than before. As I've said, we don't know if the bottom is really in. But if you've got a really long-term view, and if you're able to deal with volatility, and unfortunately it seems that not too many investors in these markets do have strong nerves and a long-term view. But if you've got that, I think they're a very good buy, because we have seen panic yesterday. We have seen Barrick Gold, for example, down 10%. The HUY index was down, I think, 11%. And this all happened on very, very high volume. So this would, from my point of view, definitely fulfill the requirements of a so-called panic low. And I'd say, okay, the worst is probably now behind us, but fortunately, sure. And that's also a very, very honest insight by the Austrian School of Economics. They're saying it's impossible to predict the future. And after years in research and in asset management, I know that this is true. But you can prepare for different scenarios, and that's what we're doing.
I remember in 2014, January, we just, came out of 2013, and it was a rough 2013. I mean, precious metals kept going down. And then I remember precious metals really started to have like this rise, and then I remember companies started to do good, like they all rose, and money started to flow back in the markets. And then they got decimated again, like 5 or 6 months later, with more precious metals falling, gold falling, silver falling. And I'm just wondering if you think, I know you said that the bottom might be in, but my question is the latest takedown with the precious metals prices, does that kick the can down the road even further for a longer bear market, because people are more discouraged, more frustrated, therefore the metals are more hated, so it's more difficult, for more money to come into the arena?
Yeah, that's a very good point. I think people who are really disappointed and kind of fed up with investments, it takes quite a lot of time and price increase to get them back. I would say that especially institutional investors, they will not start buying into gold until we're like 20 or 30% up, because they always buy past performance. They cannot act as a contrarian investor because they've got career risk. So they just follow the crowd. I think I wouldn't expect a V spike, so gold rallying up to 1,200 or whatever in very short time. Normally it would stabilize and go sideways, perhaps slightly higher going forward. But what we definitely need is a catalyst. Now, what could this catalyst be? perhaps it will be the rate increase in the US, because that was actually was everybody is kind of waiting for, and I don't know if there's this saying about the Damocles sword in English as well. I think this is what's putting pressure on gold, and we have seen the same with the whole tapering discussion. Actually, when tapering started, gold started to rise again. And in my report, I'm also writing extensively about gold in an environment of rising interest rates. And what mainstream media would say is that rising interest rates are bad for gold. So interest rates rise and price of gold falls, but this is not true. In fact, the three biggest rallies happened in an environment of rising interest rates. So we really have to focus on real interest rates. And if you really want to turn the corner in gold, we have to see upward momentum in price inflation rates again. So unless we don't get out of this disinflationary environment, I don't see any bigger catalyst for gold.
Well, Ronni, if people want to reach out to you and learn more about your information, where would they go and what would they find?
Yeah, well, we've got all our publications on our webpage. It's www.incrementum.li. We've got the In Gold We Trust report on the webpage. We also got the 2014 and 2013 edition. We've got chart books. We've got the transcripts of our advisory board, for example, where Jim Rickards, who you probably also know and follow, is also a member of our advisory board. So there's really plenty of things to read. Of course, there's a very long introduction to the Austrian School of Economics on our webpage. So feel free to have a look at the webpage, and just contact us if there are any further questions.
Yeah, absolutely. Definitely check them out. Ronni, thanks so much for taking the time to come on the show with me. I really appreciate it.
Thank you very much. It's been a pleasure. Thank you.